All right, Palantir stock is the SaaS business model, the analytical software that's kind of taking the stage by storm, if you will. It's all over the internet. It's a very popular stock. It has a very outgoing, energetic CEO founder that's running this business. They're seeing phenomenal revenue growth, positive free cash flow. They're having high customer retention. And they continue to grow revenue. They just raised their revenue guidance to $2.6 to $2.7 billion next year, 2024. So let's take a look at this stock. Now, I've never reviewed the stock before. I'm going to dive in. I'm going to build a cash flow one-pager, kind of live in this recording, to kind of go through pulling financials, assembling the forecast, thinking about the business a little bit. And I just wanted to do that live and kind of think through this business with you guys and kind of tackle a new project. So let's dive right in. You ready? Let's get to work. Welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you for watching the channel. I greatly appreciate it. This week we're doing Palantir. I've got the website up and I want to go through it, pull down some financials, take a look at the stock, and figure out if we can build a forecast with some limited information. Now, this is going to be a big kind of caveat here. I have not done a deep dive, and I expect you guys to do that on your own due diligence around the software and the kind of growth it could achieve. We're going to kind of take a guess at it and just show you what's possible. But going through the financials is really what I want to do to see what they've done historically before we start building a forecast. Now, what we're going to do is we're going to review this stock, the 5 key attributes that we use for all the businesses, right? Top line revenue growth has to be growing, profitable with EBITDA, strong free cash flow, low debt, and a well-priced stock. Those are the 5 things we look for before we go to further due diligence. Now, let's dive in. I got the web page up for this stock. The founder here, he's always, Alex Karp, he's always out front, forward-facing CEO. Really love that, by the way. Absolutely love his passion. You can see it in all of his videos. And it looks like he knows what he's doing. I mean, I don't really know. It's very tough to understand their products. Their products are kind of like a black box of what is AI. They've got AIP, Foundry, Gotham, Apollo. These are different SaaS service offerings that will kind of use data for different industries to provide insights to the owner of the data. Kind of runs as like a SaaS model, or kind of think of it like an enterprise software. Once you get it in and get it built out, it's very sticky, very hard to remove from your system. And I think that's why they have high customer retention and they're growing revenue, which to me would indicate that their service is working. Even though I believe it's the Gotham, which is government agencies, and is pretty nebulous about the level of services they provide, the detail, because it's a government service. They keep it kind of pretty tight to the chest. But they are expanding their services. Last time I checked this website, it wasn't nearly as robust as it is now in terms of the number of offerings that they or number of services or sectors that they provide service for. Offerings. Literally, it's called offerings. I thought this was actually an interesting page, kind of just framing up some of the different offerings, to say the least, that they operate in: money laundering, applied customer intelligence, AI, machine learning, automotive, consumer goods, crypto, data protection, defense, ecosystems. There's kind of a lot. I think what they're doing here is they're kind of taking a complex subject, which is their data analytics, and they're compartmentalizing it for the laypersons, just myself, to say, oh, I'm in the consumer segment, so I'll take a look at the consumer goods. Oh, you can solve my problems. Let me take a look at that, and kind of walk down the lead funnel, which I think is a good use of their website. But let's dive in to see kind of what their financials look like, what they've done to date, and kind of begin to assemble a forecast. So I'm going to pull up a blank cash flow one-pager, and we're going to start pulling together some of their financials just to see what they do. So first things first, let's put in what is this? This is the cash flow statement. So we'll just move this over. I'll call it cash flow. And what I want to do, we only have 5 years of data here, so that's not that much. I want to reorder this so it's actually horizontal. It serves my purposes a bit better. And I got to multiply everything by 1 because it does not like the numbers when they come over. Let's do this. Let's figure out what kind of operating income they have minus stock-based comp. So they made, wow, the stock-based comp last year was $475 million. That's a lot of stock-based comp. Let me check the check their actual 10K for that first. Make sure this is right. Stock-based comp is on the cash flow statement. Yeah, stock-based comp, $475 million of stock-based comp, which is an absolute ton. Wow, what did they do in revenue last year? So if we go to the income statement, 2.2 billion of revenue, 475 million of stock-based, 475, 2225. 21% of revenue was paid out in stock-based comp last year. Oh my God. What about the year before? Stock-based comp, 564. These are thousands, millions. 564 million on revenue, 19 billion. 564 divided by 1905. 30% of revenue was paid out of stock-based comp. Okay, that's going to be very tough to overcome. Let's keep going. That's just alarmingly high, but I don't know what to do. We might have to change this on the fly. Let's see what goes on. So we're going to take adjusted cash flow from operations. This is 2024. I think with this data is 2023 is the last year we have of actual data. 2023, let's come up. It is 2018 is the first year of data we have. Let's go adjusted cash flow from operations. A negative. Let's go pick up our CapEx. How much are they putting in CapEx? CapEx, 15 billion, not much. Debt, let's figure out what do they have. So we want long-term debt, short-term debt. Here, let's make sure we get, if there's any blanks, we want to find a blank and replace it with 0 just to be sure. So here's our debt. They don't have any debt, or at least they're not paying off any debt currently. That's a plus. Okay, we got the cash flow statement done. Let's figure out what's next. Let's go pull income statement. Let's move Alt HOM. We'll move that over to the one pager. Alt HOR. We'll relabel. We'll call it income statement. We need to pivot this because this is vertical data. I don't want to move it horizontal, so I'll transpose it. I'm going to multiply everything by 1 so that it comes through, because when I download this data, Excel doesn't recognize it as a numerical value. So I'll just multiply everything by 1. That's not working for some reason. Why are you not working? Maybe they did. Okay. Let's go drop in the revenue 2018 income statement, $595 million. Okay, and it's grown to 2.2 billion. That's fantastic. Let's go fetch the EBITDA. So we can get EBITDA here is a loss, and it's coming positive. Okay. Let's pick up shares outstanding. Now we want fully diluted shares outstanding because they are issuing a ton of stock. You got weighted average here. This is the fully diluted column. So we'll pull fully diluted shares. And then that's all we want from the income statement. Let's go get the balance sheet. Balance sheet. Let's begin HOM. We'll just put this over. We want to relabel it. call it the balance sheet. And like I said before, I like everything in a transposed manner so that we can drop it into our cash flow, which is set up a different way. So excess cash, they have a lot of cash. Wow. So these two. Is that right? Wow. They have 3.6, almost 3.7 billion dollars of cash. That's a staggering amount of cash. Now, are they losing money? Yes. How much are they? Oh, they just broke positive on an operating earnings basis, and I'm just positive on cash flow even after expensing stock-based comp. So I don't need this much free cash flow. I could say, hey, I need $1 billion, let's just say, and anything above that is excess. So I'm going to say they've got 2.6 billion of excess cash, which is probably aggressive on the excess cash. I'll call it 2 billion here because they were still losing money. They only just broke even now, and I'll call it 3 billion that they need. So the excess is 600 million. That's better because they were losing money before. So even though they had a high cash balance, they needed that cash balance because they were burning through cash. Now that they've broken even, now that they're actually profitable, they don't need all that excess cash, but they're only 1 year profitable. So we don't want to get rid of all their cash as excess. Debt level, did I bring the balance sheet? I have the balance sheet. Let's go get debt. So let's see. We want total debt right here. They have a little bit of debt. It's really not that much. Total debt. There we go. Now we need market cap. We need some market data information. Need some stock price. So let's go to Yahoo Finance. Let's get historical data. I want maximum. I want monthly. Give me the max and download that, please. Really not much data because it's pretty new. It's a new company. Closing price $10, $2.50, $2.25. So it's really, really new. That's very little data. The year end is 12/31/2020. I want 2018 is what I start. And I'm gonna make that the end of the month. And we're just gonna go and get that data. There's my price. Why do I not have a December 23 value? My fault. Went too fast. There we go. So back to the one pager, let's pick up the stock price here. We've got a lot of data that's not going to make sense because they weren't public, but we'll do our best. We shall endeavor. Okay, so we don't need any of this. I will do NA here, pop that in, NA. We don't need any of that. This is the same. NA, it's not really useful anywhere down there. Okay, at least that's cleared. So now what do we have? Now we need to adjust the time frame for this, our averaging. Oof, it's gonna be rough. I'll just do the last couple years. It's not really gonna work. I mean, revenue growth works 32% a year. That's great, but the rest of this isn't going to work. So now, what do we want to do? Let's take a look at this business. It's making, revenue's growing. It was 1 billion, 1.5, 1.9, 2.2. Profitability was negative of 586 million, negative 564, negative $1 billion. Wow, I think that's when they went public. But since going public, yeah, it was public, so they probably had to clean up a lot of stuff. That's a lot of cost. And then since going public, $400 million loss, $137 million loss, and they're finally profitable, $153 million. If we go back to the statement that they made in the last quarter, 2021 Q4 highlights, they're saying, what did they say? Here's their adjusted EBITDA, 200 for the quarter, 234, margins 37%. So 234 million, margins 37%. What's the hold margin? If we just do this divided by this as a percent, it's 7%. So they're growing profitable. 37% is a strong number. That's adjusted. They think forecasted revenue we'll call it 2.6 billion just to be sure. So if we did a forecast, let's come down here for a second and just say, let's look at the year 2026, 24, and we said revenue 2.6 billion, okay. Oops, that's not what I want to do. Format. Margin, EBITDA margin, 37%. It's aggressive. EBITDA. Then, what do we need? We need some sort of like free cash flow to EBITDA, free cash flow to EBITDA. I don't think that's been profitable or positive. If I just take free cash flow, this number, divide by this number, that doesn't make any sense. You can't have free cash flow after taxes greater than the number before taxes. That's because that stock-based comp is so high. Last year, net income 217 million. Cash flow from operations 700 million. Okay, the stock-based comp is such a huge number. It's very hard to get over that. And then cash flow from operations is high because this stock-based comp number is huge. It's 21% of revenue is what they give away. They gave 30% of revenue last year. That's a staggering amount of money to give away to the employees. It really is. What does the diluted stock look like? Here's the share growth. So here they went public here. So 1 billion shares issued. Wow, that's a lot. And then the growth rate last year, what was that? Post going public, 7%, 11%. They're diluting the shareholders 11% a year when they have $4 billion of cash on the balance sheet. That doesn't make a lot of sense to me. I would much have preferred them to bring down that share count, pay their employees cash. They have the cash, and let the growth, let the incremental growth, attribute to the stockholders. I don't know what you want to do with this cash number. I think what we need to do is we need to do a long-term ratio of like 70% or something like that. 'Cause this number doesn't make much sense. I can't have cash flow from operations higher than than the income statement. That makes no sense. So I'm gonna right size it for as a 70% number, meaning after they pay taxes, at the very least, they're gonna have less money in free cash flow than they do EBITDA. It's a little bit of a guess, but I'm not sure what number to give them. CapEx is really thin, 15 billion a year. Okay, we'll do CapEx minus 15, and then they got debt. Net debt is 0. Let's just double check that. Net debt's 0. So then you got your free cash flow. You got your free cash flow to equity, and you got shares. Shares will keep flat at whatever this number is. We're going to assume that there's no more issuance of shares, which is an assumption for sure. And there's my free cash flow per share. I'll put a dollar sign on this. 29 cents. Now, CapEx free cash. The 70% number, even if it was 100%, meaning all EBITDA turns into operating cash flow, which is everything. So they have no debt, so interest is low. Depreciation, let's see how big their depreciation number is in general. Depreciation, amortization, $30 million, very little relative to everything else. So that's okay. So they could have a high, so the only thing would be working capital changes, which over time, when they're growing, it should be negative, but we can assume it's low for right now. The real difference here is the stock-based comp. This huge number of $475 million makes this cash flow from makes this free cash flow much higher than it would be otherwise. That's saying it should be 300 million. What was the number I had on my sheet? 236 million. If I go back to my calculation, 475 minus the 7. Yeah, 236. 236 million. We can use that number in the forecast. 236. What is this EBITDA growth rate over last year? It's huge. Man, 502%. We can say that free cash flow is going to grow at that rate, and just say they're going to be able to that means 1.4, 1.5 billion of operating cash flow if you add back. Oh no, that's after the expense of. That's after the expense of the shareholder comp. But again, it seems weird that cash flow from operations is greater than EBITDA. I'm not sure I like that. They used to make a lot of cash even after the removal of stock-based comp. Let's see what we get. We'll leave that ratio and we'll see what we get. Now what we want to do is, now we have margins. Let's do this as a we can take this free cash flow divide by free cash flow divide by EBITDA. We get a ratio. I'll put these in center so you can see them. Underline it, bold it, and let's shrink the font so it's a bit easier to read. Shrink the font so it's a bit easier to read. Now the question is, how much revenue, how is revenue going to grow over time? That's going to be tough. What's their revenue? Just last year grew 17%. Actually, that's less than I thought it was going to be. Let's do this. Let's do 15%. We'll just change this to blue so we know it's a forecast. And we'll take out 1% a month. It's gonna be a year. Just bring it down. I mean, I don't know what they're gonna do. Do you? They did 17% last year. They seem happy with that. Okay. As you get bigger, it's harder to grow as fast. So let's just say that revenue grows at that rate. Now I have a revenue forecast. And we know margins are 37%. At least that's what it was last quarter. That still seems very robust to me, but I'll hold it there. We can now have an EBITDA forecast. If we assume EBITDA, free cash flow to EBITDA ratio, then you've got your EBITDA times your ratio. Again, this makes cash flow from operations higher. This is adjusted cash flow from operations. Higher than EBITDA. Okay, CapEx is going to have to grow. We're just going to grow it at whatever the revenue growth rate was. So have some kind of cash flow growth here. Debt, free cash flow, total shares are fixed because we're expensing the share growth that's in this adjusted free cash flow number where we remove it. Yeah, that's right. $500%, it can't be right. You know what it is? It's probably the adjusted EBITDA number. Let's go back to their earnings. They quoted in their numbers here a 37% adjusted EBITDA margin. I wonder if they give us a breakdown of what adjusted EBITDA is. That probably has the share-based comp backed out of it. Adjusted EBITDA and EBITDA margin. Well, that says 24%. Here's your adjusted EBITDA. Here's 37%. That's the number they quoted me. Here's net income to common stockholders. Interest, fine. Other expenses, okay. Provision for taxes, depreciation, stock-based comp. There it is. So if we're expensing it, their EBITDA is less than that. If we want to treat it as a cash cost, their EBITDA margin, 37%, is not that high. It is 234 minus 125. Their EBITDA is 109 million for the Q. 109 million divided by revenue. What was their revenue? Revenue for the quarter, revenue divide by 634 divide by 634, 17%. So their EBITDA margin expensing stock-based comp is 17%. 17%. I'll make this blue so I know where my assumptions are. That lowers EBITDA, which in turn lowers free cash flow, because free cash flow, remember, is a percentage of EBITDA, which seems a bit better now. Okay. So now what we've done is we've expensed stock-based comp, because stock-based comp is a real cost. And we're treating it like cash, like a cash cost, because I don't want to inflate the stock shares outstanding over time, because I don't know the price of the stock at which those are issued. So what I'm doing is I'm holding shares outstanding constant, and I'm treating the stock-based comp as if it were a cash cost, expensing it on the P&L and expensing it in cash in the cash flow statement. And what I get is a 17% EBITDA margin and a free cash flow of about 680 million, which is a strong free cash flow, by the way. No knocking that over time or next year. Okay, so let's put this into our forecast and see what we get. So now we've got a forecast. We know what 2024 is. I'm just going to drop this in here. that like that thusly and pull up my free cash flow per share, which is 29 cents per share, and it goes to, drum roll, 74 cents a share out in 2023. Let's do growth rate so we can see kind of what we feel about the growth rate. -1, that's a big growth rate. Minus divided by that -1. Now, why is that growth rate so high year over year? What do we feel? So last year they did $153 million of EBITDA. Next year, this coming year, I'm expecting 442. What was their quarterly EBITDA? Again, this is adjusted. We did adjusted. Oh yeah, it was the 100 million. So it was 234 minus 125, 109 million times 4 for the core. 436 million is what they should do. 436, that's fine. Last year's EBITDA, I don't have the adjustment. That number could be with stock-based comp, could be without. But their margins are growing if they're going to go from 17% last year to, 7% last year to 17% this year. That seems reasonable and aggressive. I'm fine with that. And then after that, if they haven't grown revenue much, we stabilize margins. I don't think margins they could get higher. We could lift margins. So over time, margins could grow because as they get bigger, stock-based comp will come down as a percentage of total revenue. So their margins should creep north, and most software companies have high 20s. I mean, as high as 40% if you look at a Facebook or like a Salesforce, some of those things. Let's creep this up to say 30%. Just say we can add, if we added 2% annually as they kind of grow, that gets us to 35% margins on revenue. Revenue is probably not going to drop down. I'll do 0.5%. Talking myself into a more aggressive forecast, but these guys have a lot of runway. I don't want to shortcut it too much. So now we've got double-digit growth for a decade, a bigger assumption on revenue, and we got growing margins over time. They're still going to pay out stock-based comp, but as revenue gets bigger, they can afford to pay out stock-based comp. As the company grows a little slower, stock-based comp will be smaller. So, okay. And then cash flow EBITDA is still 105% of EBITDA. That's still an aggressive number. CapEx is low, no debt. Okay, then there's our numbers. So let's just say if these were right, what does it produce? Well, it produces a business that's going to go from 153 million of EBITDA last year to 3 billion of EBITDA in 10 years. Wow. That's a huge number. No doubt about that one. So if that is 3,000 divided by 150, call it's 20 times. Yeah, could have done that mental math, but it's 20 times. Massive growth. Market multiple, currently market multiple is 250 times earnings. Youch. In 10 years, you have a business that's got very high margins at 35%. It's growing at double digits. It's got no debt. it would deserve a 20x handle. It just would. That's kind of what those trade at. That means it's a $60 billion valuation, an enterprise value, less, zero debt, no extra free cash, shares. It's $26 a share, out 10 years. Let's take a look at the free cash flow. So free cash flow itself is going to grow substantially over time. That's a 200% growth over last year's number. And if I annualize that, just out long term, we're talking 20 to 30% annual growth rate of cash flow. The free cash flow yield is now currently at 0.5%. I'll give it a 1%. That can't be right. 1% or maybe a 2%. 2% cash flow yield. That's $100 a share. These are wildly different numbers. And I think the difference is really this assumption of the split of cash flow and EBITDA. Let's go back to the annual report and take a look. Here's adjusted free cash flow margin. So they're at a 36% free cash flow margin. But again, they've got the stock-based comp added back here. This is income from operations. Let's bring up our calculator, and they're saying 226 is the adjusted income from operations. No, I want the one below it. This title here belongs to this section. So this is free cash flow. Here's your cash from operating activities. Cash paid for employer payroll-related stock-based comp. Purchase of property, plant, and free cash flow. So if I take 129, they have your numbers 148, and I move the 148, and I remove the 21 million or 22 million of stock-based comp. Then I'm at 120 million of free cash flow. If I divide that by the revenue was what? 634. That's a 20% free cash flow margin. Let's see what that that's cash flow from operations. Let's just do CFO adjusted margin. Let's just see what this divided by this is to see if it makes it 26% to 50%. That's too high. Okay, so that's what's driving this. We need to bring this down. 20% is fine, but I can't have 50% of the cash that they're generating. They're gonna have to pay income tax at some point because they're generating so much cash, and this 105% is wrong. The EBITDA number, remember, excludes income tax. So at the very least, they're going to have to pay 15% or 20% of that cash, depending upon the corporate tax rate of the EBITDA is going to have to go. So free cash from operation should be lower than EBITDA over time. I'm going to bring this down. I think it's got to normalize such that at least this 26% margin is maintained. And maybe that's a better way of doing cash flow from operations, just on a margin basis instead of this ratio. Let's do it that way. We'll leave this, or we can keep it at 26. We'll do this. 26 will make free cash flow as a percent of, we'll make cash flow, adjusted cash flow as a percent of revenue rather than having it driven by a ratio of EBITDA to cash flow. And then what we'll do is we'll just make this a ratio here, and I'll just hold it flat, or we can bring it down. But that definitely brings down. And now we'll set this ratio cash flow EBITDA. We'll make this one a formula, so it reverses. That feels a bit better. Where as they get bigger and they're producing more free cash flow, as stock-based comp comes down as a percentage of total earnings, they're going to have to pay income tax. And so you'd expect cash flow from operations, which is after the taxes paid, would be lower than EBITDA, which obviously excludes taxes. So now they're making 35% EBITDA margin. They're making 26% free cash flow. So they're paying 10% in taxes, assuming there's some depreciation, there's some monkiness there that they can shelter, whatever. That's going to lower free cash flow per share and make it look a bit better, $48 versus $26. I think that's a fair approximation of what you can expect. Call it $1 free cash flow out 10 years. So now let's figure out what the stock price is currently trading at. We're in June 2024. What's the stock price trading at today? Palantir, $25. $25. So on a forward basis, EBITDA is trailing. Forward EBITDA basis, I'm at 121 times forward EBITDA, and I'm at a 1% forward free cash flow yield. I buy this stock today at $25. It's going to go to $37 in 10 years, and I'm going to get some stream of cash flow. That's a 7% IRR. So let's check our assumptions here. What's driving this change? So we've got a business that last year generated $153 million of EBITDA and $2.2 billion of revenue. We expect revenue to grow. I don't think anybody's going to doubt that. This growth rate last year, they're forecasting a 17% growth rate this year in 2024. Okay. Are they going to grow even faster next year? Maybe. I don't know. It's still positive. It's still double digits, whether it's 17 or 18 or 15, whatever you want to think it is. Let's call it double digits for a decade. Margins improve. Margins widen. They almost double from 17% to 35%, making an EBITDA of $3 billion out in 10 years from now. That's a big number. They did 153 billion last year. They're going to go to $3 billion. Okay. Free cash flow from that $3 billion is going to turn into $2.2 billion of annualized free cash flow from operations. CapEx, relatively low because it's a software business. No debt. We don't have them borrowing any money. So all that flows through to you and I, the stockholders. We kept shares constant because we expense stock-based comp, and I get $1 per share free cash flow. Well, the trick is, or the question is, what market multiple do you, as the buyer, want to apply to these shares? It's currently trading at 130 times forward EBITDA. Okay, so fast forward 10 years, we've grown. Think of Amazon, think of Microsoft, think of Google. These massive growing companies, right? Netflix, Nvidia is probably in the pipeline, right? So the beginning stages or kind of the top of it, if you will. But Microsoft, Amazon, Google, those have all kind of gone through their evolution. That market multiple is going to come down. It just is. It's not going to go up. It's not going to go from 130 times to 225 times. It's going to come down. Is it 50x? Is it 20x? I don't know. But out 10 years, if you've got the stock that's growing, I think 20x is a still robust market multiple for a very strong company. Even if it was, let's say, 30x, what would 30 do? And we left it at 1% here. What does that do? So there's your market beating return, 13%. Again, 13% return on a risk-adjusted basis for a company that has to grow, what do we say, 20 times? Doesn't seem fair. We can get 13% on businesses that need to go 2% a year of revenue. So if I'm a betting man, which I guess I'm invested in the stock market, so I think that makes me a degenerate gambler, it's too high for me. I'm going to go with a 20x market multiple, which I think is a strong premium in general for a company, and I got a 2% free cash flow yield. This is a cash flow channel. I want cash flowing assets. The cash flow here is very thin. So for me, this is a meh stock. The market multiple of 120 times, 130 times market multiple is way too high and is sucking up all the future earnings. So I'd stay away from this stock. I think the stock itself is going to grow. The business is going to grow. The opportunity here is amazing. However, all of that is priced into the stock already. And I think it leaves very little upside for you and me, the retail investor, and it leaves an awful lot of downside if this business fails to live up to its promise. If for some reason it should fail, what would be the price? Like if we said next year the stock is going to do $442 million and it's just going to flatline. Well, what's 20 times multiple? What's the stock price for a company at 20 times doing 442 million of EBITDA? Let's see. So this is 20x. This is EBITDA times 20. That gives me a market cap of $884 billion. Cash and debt, relatively nothing. I'm going to wash those out for, I'll wash those out for the time being. Stock outstanding, 2.2 billion. That means the share price would collapse to $3.85. So I'm buying a stock at $20 that I think could grow to $37. However, if growth fails and the market multiple of 130 times comes down to earth to 20 times, that means the stock price collapses to $3.85, an absolute devastating loss of almost 90% of your investment. I can't endorse this one. I think there are other opportunities that have greater upside with less downside. Let's review the 5 key attributes. Number 1, top line revenue growth. Yes, it's growing. It's growing strong, 32% annualized. Number 2, EBITDA. EBITDA is strong and it's growing. Good for them. They're going to grow that. Number 3, free cash flow is strong. It's growing. They've got a shit ton, an absolute shit ton of stock-based comp. 20% of revenue is being given away to the employees. That is way too high in my opinion. But I'll check the box because over time, that will come down and they will have free cash flow. Number 4, low debt. Debt is 0. Good for them. Number 5, well-priced. Is it well-priced? No, it is not. I'm a hard pass on this stock. I think there is better opportunity in the stock market for a long-term investor to accumulate wealth by buying stocks that go up slowly over time with a lot less downside. In my opinion, this downside could be 80%. If it fails to achieve its growth or the market multiple, particularly the market multiple, comes down over time, it's going to weigh on the return. Will the stock go up? Most likely. Is it going to go up enough to warrant the risk? In my opinion, no. So this has been Palantir. I wanted to kind of dive through this business a little bit. Send me the comments. Let me know what you think down below, and we'll be in touch. Throw a comment down below. Check out my website, cashflowinvestingpro.com, where I have the Cash Flow Club. We go through one-pagers like this. I'll post this into the Cash Flow Club one-pager so everyone can see it. Hope you like the Palantir. Hope you like the live demo of how we do one-pagers. It's kind of a guess because this is a new business for me, so I admittedly don't know a lot about how the software works, but I applied a very robust growth rate, and for me, without further diligence, I'm going to pass. I'm sure lots of you will disagree. I'm happy to take questions or comments. Again, I've got a business here that I'm modeling out. It's ultimately going to make $3 billion a year in profit, but a reasonable market multiple of 20 times means it's only $60 billion of enterprise value. It's currently trading at $40 billion of enterprise value, so most of the future gain is already priced in the stock. What upside is there for me? But thank you for the time. I appreciate it, and have a great day. Bye-bye.